Graeme Franck from PSG Wealth Sandton Graytson joins us now for a full look into the day that was in markets. Graeme, thanks so much for your time today. So, economic data in focus yet again over in the US. We have the labor market there in focus with the private payrolls declining by 32,000. Another print just strengthening the case for a Fed rate cut, right?
Yeah, you're right. And I think you said in your introduction, we're expecting another Fed rate cut next week, which, as you say, this should strengthen that. I think also very importantly, Jerome Powell gets to step down. He's coming to the end of his tenure, and we're expecting an announcement from Donald Trump, and it could be as early as Christmas or perhaps early next year as to who will replace him. And as you well know, Trump has been beating on Jerome Powell for not being sort of dovish enough and not cutting rates quicker and not boosting the economy more. So there's a very good chance he appoints someone that will be more sympathetic to his cause, which again could be good for markets and even further rate cuts into next year.
So on the bright side, we are seeing, a more dovish tilt when it comes to the Fed. However, there seems to be concerns yet again around the US economy and the health of the US economy. Are those worries warranted at this moment, looking at some of the data that has come through?
Yeah, absolutely. I mean, I think also what we're seeing is some of the data in the real world, which is starting to soften a little bit. And yet we're seeing company earnings, albeit historically, backward looking, very, very strong. So the worry is slightly that the real economy will feed through to slightly softer expectations for company earnings.
Yeah.
And obviously that'll be bad for share prices. So kind of on the one hand, you've got potentially lower interest rates to boost US markets, but then, moderating of earnings expectations to soften them. So a bit of a balancing act at the moment.
Let's move over to some company news out here at home. Nedbank saying it's delivered a resilient performance in the first 10 months of the year. It is expecting an improved environment next year. Speaking to, the shift in sentiment that we have been seeing when it comes to the local economy.
Yeah, 100%. Ironically, Nedbank actually shifted down their guidance a little bit, but then for the next few months.
Yes.
So in other words, what they're going to report now, but they boosted confidence thereafter. So they're basically saying they are seeing an improvement in the economy after interest rates have come down. They've also bought back over 10 million shares. They spent about 2.5 billion rand on share buybacks, which is always very, very positive. And we're hearing similar views coming through from from FirstRand and Standard Bank. So certainly, albeit lower expectations, I think the outlook at the moment for the South African economy is good. But we've said that before, haven't we?
Yes, we have, and we're just waiting for it to really filter through to real growth, where we're actually seeing it coming through in the numbers and coming through in the environment where people are getting jobs and they're earning more. The Nedbank print, the update also really supports what we're seeing out when it comes to business confidence numbers, right? With morale notching higher in the fourth quarter, but still within that contractionary level. Just your thoughts around that business confidence print we got out earlier today.
Yeah, as you say, confidence is improving quite dramatically. The only negative thing I would say, just a slightly left field observation, is the betting companies, so Betway, Hollywood Bets, etc. I'm hearing more and more that is starting to depress the consumer spend in the economy because it's so addictive. But I mean, that would probably have an impact on some of the retailers. But as I say, the banks are quite bullish about what the prospects are at the moment.
All right, let's move over to Raubex, that group weighing up a potential sale of Bauba. That segment didn't do well when looking at its last financials, higher chrome prices and challenges at its mines eating into profits. What do you make of this potential move, also considering the kind of challenges these chrome operators have been facing?
Yeah, I think it's a good move. The market cheered it on when I last looked. It was up 2.5%, 3%, and it basically means they're going to go back to their core, which is civil works, road building, construction, that type of thing, and they're going to shore up the balance sheet by selling their mining operations. So really just streamlining certain operations.
Let's move over to your stock pick. What are you hanging your hat on today?
So I'm going to go for, again, the blue chip in the market, Naspers. I looked earlier, and over the last 1 year, Tencent is up 51%, and Naspers is up 21%. So there's been a massive divergence, which basically means that the discount to net asset value for Naspers is now sitting at a very high 47%. And basically, the net asset value is made up predominantly of Tencent. So there is, of course, worries on certain US tech shares. The Chinese tech shares are playing a bit of catch up, and Naspers trades at a very, very chunky discount to its Tencent holdings.
All right, let's leave it there. Graeme, thanks so much for your time and sharing your insights with us this evening. That was Graeme Franck from PSG Wealth Sandton Graytson.